next guest predicted the 2008 midsummer collapse in the commodity market. Now he's looking to a different asset class for opportunity. So here to tell us what he sees on the horizon in 2010 is Mike Aronstein. He's Chief Investment Strategist at Oscar Gruss Son, and he's with us here now. So in looking through your notes here in your pre-interview, you indicated that you're fairly bullish on the United States right now. You're feeling better about what's happening here. So why less exposure to the commodity market?
I just think that trade became a little bit too popular for my tastes. I think there's not as much controversy as there was 11 or 12 months ago when people really invested as though the world was on the brink of ending. I think the last point of controversy right now is about the strength of the U.S. economy. And, you know, we've held the position that we're in a classic V-shaped recovery. It's going to be normal or stronger than normal. And I think there's still quite a camp that doesn't believe that and is investing too defensively for the cycle that we see. So the risks I see in the market are that strength becomes a provocation for the Federal Reserve to do something, and that the Fed, rather than being preemptive, is reacting to strength at a point much earlier than people expect. I think this quarter is going to really surprise people on the upside.
You're looking for more earnings buoyancy this quarter. But what do you mean when you say you're afraid of what the Fed might do or might be forced to do here?
Well, I think the risk in this market would arise at a point where economic strength provokes some tightening of monetary conditions. And
what kind of horizon would you be considering there?
I think within the next 6 months, and maybe sooner than that. I think despite the fact that Chairman Bernanke is sounding quite dovish, no, they are compelled by events. They do not act in anticipation of moves in the marketplace. They react to what occurs. You know, the ease that finally took place after the collapse of Lehman Brothers was something that should have occurred in �07, really, and it wasn't until we were on the verge of a complete shutdown in the global monetary system that they reacted.
Now, when you talk about the next 6 months, are you looking at the federal? Are you looking at interest rates being hiked, or are you looking at other kind of pullback?
Well, I think market rates,
draining, rather, I should say.
Market rates in the part of the yield curve that's sort of separate from the Fed's influence, or at least somewhat removed from it, are already moving up. And you have record or close to record steepness in the yield curve, and that usually is a precursor of the Fed's portion moving up. You know, the yield curve tends not to get infinitely steep, even though it's close to it at this point.
Turning back to commodities, because that is a space that you've been ahead of the curve in making calls on. When we look at the Bloomberg survey most recently of market watchers out there, raw materials are forecasted to return more than financial assets for the first time in 3 years, according to the consensus among those we've surveyed here at Bloomberg. You could be of the party that says if it's consensus, it's got to be wrong, or you could say perhaps there's a flaw in the theory you're exposing right now.
Well, that the outperformance of commodities versus U.S. stocks has been the case for the past decade. And people do tend to extrapolate.
But you have taken yourself out or reduced your exposure to the commodity market as of November.
Yeah, I think the hypothesis can be played more safely in U.S. equities, particularly those with a more cyclical bent, because there's less popularity there, less expectation. I think the expectational level, even though they're both driven by the same motive forces, in my viewpoint, which is buoyancy in the general economic environment, one is quite well loved and the other has been subject to a lot of despite and neglect. So I think it's just from a risk-adjusted standpoint, you're better off playing that hypothesis from the standpoint of equities.
All right. Interesting to note. You say that the commercial real estate market is not something you're overly concerned about because everyone is concerned at this point.
Crises are never advertised, not generally. And when you see them routinely discussed through magazines and every day there's another article in Bloomberg, I don't worry about it.
Good. Thank you so much for joining us.